I say that to say this, with all of these syndications and all of these deals going sideways, um, just in your local market in the DFW area, what's it like trying to raise money when so many people probably are getting wiped out? Because the bank is in a senior position on the majority of those multifamily syndications, right?
Look, I would like to take a 10-minute break and then three, two, one. How do you have the ability to analyze stocks?
Welcome to the Generations of Wealth podcast. I am your host, Derek Dombeck, and today we've got a kind of a brother from another mother. He's got some Polish roots to him. We'll talk about that a little bit, but he's coming at us with about 10 years of experience. Really interesting story as far as how he got to where he is. Like always, I try to bring you the best guests we can possibly get on the show, and I think we do a damn good job of it. So before that, let me help you find people that are going to grow your network, whether that's my guests or friends of my guests or friends of mine. Doesn't matter. Let me help connect you. Reach out to me anytime you need something at derekdombeck.com or thegenerationsofwealth.com. So with that, let's bring on Matt. And with no further ado, here he is, Mr. Matt Buchalski. How are you doing today, sir?
Derek, I am doing fantastic, my friend. I'm excited to be here. Thanks for having me.
Absolutely. We were just chatting before we hit record a little bit about our heritage, and we both are Polacks, with some other mixtures in there. But for
That's
those of you that
right.
don't know, Polish people are just all fun loving, and it's fantastic.
Absolutely. Yes.
So
Fun-loving, intelligent, good-looking,
yeah,
all the best qualities.
absolutely. And if you're not watching the video of this and you're only listening to the audio, just take our word for it. Why would we
That's
lie?
it.
Yeah.
We have a voice for radio.
Perfect. Perfect. Matt, why don't you tell the world a little bit about yourself and I'll stop giving you a hard time for at least a minute.
Oh, you're good. Thanks again for having me, Derek. So my name is Matt Buchalski. I have been a real estate investor now for the past 10 years, which is crazy to say. I still remember my first deal like it was yesterday. I'm a dad. I am a husband. I'm a father. And in addition to my real estate investing journey, I am a podcast host, and I'm also Chief Revenue Officer of Compare Power, which is Texas's largest independent electricity brokerage. So there's not enough hours in the day for me on most days, and I like to cover a lot of ground and stay real busy building businesses, taking care of the family, and trying to have some fun in between.
And you carved out some time for this show, which is awesome and we really appreciate. Um, what got you started in your 10-year career? What led you to real estate? And when you said I still remember my first deal, it's been 23 years for me, and I still remember my first deal. And I don't remember a lot of them in the middle, but I remember the first ones. I think we always do and always will.
So I was working for Hewlett Packard Enterprise at the time, and I felt like a cog in a wheel, right? I was running like a 60 or $70 million a year business within a $25 billion a year company. And I'm like, if God forbid something happened to me, or if I totally missed my number, or on the flip side, if I had a total blowout year, my overall team's productivity is a rounding error in the grand scheme. And I'm like, I want to own something that makes me feel like less of a cog in the wheel and helps me kind of flex my entrepreneurial spirit. So I had this bug to do something outside of the my corporate lifestyle, which has done very well in my career. I'm super blessed, but I just wanted more, right? And I wanted more without, being on the road 250 days a year. I didn't want to, leave my family behind as I pursued this growth trajectory. And so I really kind of went down this list of values and stuff that I wanted to embrace. And then, I used to put together these annual tuna trips with my buddies and me back in New York, New Jersey before I moved down to Texas. And one of the guys on one year on the trip told me that he owned 50 single family homes on the east end of Long Island. And we talked for like an entire afternoon about how it worked and what he did and how much money he made and all kinds of stuff. And I was kind of salivating at the mouth. And after the trip the next day, he says, "Listen, if you're ever interested in buying anything, let me know. I got a broker that knows my buy box and would happily help you out." So I took him up on it, had a conversation with the broker a couple days later. And then that was like August, September timeframe. The broker called me in March and said, "Hey, I got something for you." And it fits Pete's buy box. Pete would buy this deal if I showed it to him, but I'm bringing it to you. And I bought it. And it was, $100,000 single family home out in Mastic, Long Island.
Mhm.
Not the best part of town, but the goal was, or the plan was, to buy the house, throw a Section 8 tenant in there. And I think back then I was getting like 1,800 a month for $100,000 home. I've had to put 4 or 5 thousand bucks into it just to get it past the Section 8 inspection.
Mhm.
But I just sold that one 2 years ago. And I mean, if I could make money like that on every deal that I had in my portfolio, I'd probably be on a boat somewhere in the Mediterranean right now. But it was a great deal. It wasn't pretty. It wasn't something that you go show your friends and family and that's like super proud of you about. But I left myself all the way to the bank on that one.
Well, that got you, I guess, the taste, right?
Mm-hmm.
And then you got hooked since you're a
Mm-hmm.
fisherman, right? You got
Yep.
hooked. Your buddy wiggled the worm. Um, but that you kind of taken it to a bigger level than that now, as far as how you find your deals and how you market for your investment stuff. So why don't we fast forward a little bit?
Yeah. So I bought my next property, very similar model, 90 days later. And fast forward to today, I have 200 units across Texas, North Texas, and Waco. And then we also have a 100-unit RV storage deal that I'm a GP on. Actually, it's more of a JV structure. And honestly, we're just waiting for the market to bottom out a little bit more, and go back on a buying spree. We made our last acquisition 2 years ago next month, and we've really focused on operations and occupancy. And while the market kind of resets, but I think we're there or almost there, and we'll be back on a buying spree later this year.
Yeah. So what do you're seeing the market just locally in Texas, or are you talking um do you still have real estate in Long Island area or just Texas?
Now I'm just in Texas. So I
Okay.
sold that one property back in 24, like literally at the peak of the market, which was great. But everything's here. So we have a cluster of assets in Arlington, about a mile and a half, 2 miles west of AT&T Stadium. We have some assets in Richardson. We have some assets in Garland, Cleburne, and Waco.
So what are you seeing with the market? You said you're kind of waiting to see if it bottoms out a little bit more.
Yeah.
Um, what are the telltale signs that you're kind of watching for?
So we've already seen, at least in multifamily, right, which is our core asset class, we've definitely started to see an uptick in REO and lender-owned assets.
Mhm.
And, I think for the most part, when we've underwritten those deals, they're pretty much being offered at the loan amount, and it's arguable whether the original loan amount even fairly valued the property.
Mhm.
But with banks already owning assets, and then there's a lot of assets that are just kind of like on life support or however you want to call it. We think those assets are going to move themselves through into forced sales or just foreclosures here over the next 3 to 6 months. And with all that inventory, all that supply, we think prices are going to come down even more, right? If you think about it from a macro perspective, in just the last couple of years, we've seen interest rates spike, we've seen expenses spike, we've seen cap rates decompress as interest rates have gone up. And so some of these deals just don't mathematically make sense anymore for the investors and the GPs, let alone in some cases the bank. So I think we're going to see a big price correction come through as more and more of these deals fall into the bank's hands. Um, Most of those are probably going to be B and C class assets, and I think that's going to put further pricing pressure on what is an already uh, 20 to 25, perhaps 30% haircut from pricing that we saw 2, 3 years ago. And but companies like ours that have access to capital and equity, I think will create a great buying opportunity for us. So between the amount of foreclosures that we're hearing about, the amount of distressed assets that are out there that are just going to come out of runway, and assets that may have just been hanging on by a thread because of capital calls and whatnot that weren't able to achieve the rebound that they were looking for, those deals are going to come to market here later this year too.
Yeah, and my show I released last week was really great. We were talking about raising a ton of money and how to do it. And one of the things I brought up in that show was, my syndications that I'm working on, I don't like using institutional debt.
Mm.
I don't like working with institutions. I like working with people. So I say that to say this, with all of these syndications and all of these deals going sideways, um, just in your local market in the DFW area, what what's it like trying to raise money when so many people probably are getting wiped out? Because the bank is in a senior position on the majority of those multifamily syndications, right?
Hmm. Hmm.
So what's the temperature like down there from trying to raise money as you want to go in and acquire after it bottoms out?
Yeah. Well, we haven't tried to raise equity now in 2 years, so I can't speak from firsthand experience. What I can tell you is that other GP teams that we know have tried to raise equity. Everyone who I know has tried to raise equity lately has closed, but
Mm.
it's taken them, 2 or 3 times as long as it did a couple of years ago. And, I was recording an episode of my podcast earlier today, and my guests said that they just closed on a deal, but the GP team basically put in the equity, and now they're raising investor capital after closing, right?
Mhm.
And that even with that level of commitment in deals, investors are kind of leading with the blood on their sleeve, saying, they lost money, either, they have lost money or they're on track to lose money, and it's just dragging out the equity raise piece of this. And I think, sorry, ADD moment. I've also seen, my fair share of posts on LinkedIn and Facebook and other social media where, even brokers are coming to the table and posting about losses that people in their network have taken. So I think there's definitely, a black eye
Mhm.
with some of the investors that are out there. But, the way I look at it is we've probably all bought stocks that didn't work out as well as we thought they were going to, right? But we probably all still have mutual funds and IRAs and 401ks and stocks, and we didn't completely abandon that market. So, if anything, what we're probably going to see is investors who have taken paper losses or actual losses either sit this next round out or just be, a lot more cautious on the GPs that they entrust their funds with.
Well, and they should be. I mean, obviously, whether they're putting their money into a stock market through a stockbroker or they're coming in through a GP, they gotta trust somebody.
Yeah.
And yeah, it sucks, but also now is the buying opportunity,
Hmm.
and the savvy investors are going to see that. Hopefully, they're smarter now. They get into a better position if they're going to get into another syndication as a passive investment. But I love the thinning of the herd. I say that on the show occasionally. Like we need that up and down market. That's capitalism, right? Like 100%. If every deal was just going perfect, inflation would blow us all out and we'd be done. Like there'd be
Yes.
so I continue to raise money for my deals and always will. And it's the same thing. It's relationship, relationship, relationship. Take care of your investors. When things go bad, communicate with your investors first and foremost.
Yeah.
Don't hide. Um,
Yep.
but I think there's a ton of opportunity, and I'm not in the multifamily space. I don't really actually care for that model that much, just because I've been a landlord for a couple decades, and yeah, way too many horror stories, but we're doing developing and other things primarily in a single family space. Um, I like it. I have more exit strategies if I need them. I can lease those buildings out if they don't sell, all the different avenues. But that's specifically why I don't like using institutions. I'd rather
Mm,
pay more money to real people to be able to have conversations with real people if we need to pivot.
mm.
If the market shifts and these houses aren't selling, great, okay. I can sit down with the investor and say, here's plan B. Maybe we're going to lease this out for 2 years,
Yeah.
things like that.
Yeah. It's funny you should say that too, because I think that's a really good example. Before my partner Mike and I, we really dropped the hammer and on multifamily. We had a couple of single families that we acquired. We did like an 8 unit, and then of course, there was like this burr phenomenon back in 2016, 2017. We had to do flips. We did two flips, and after the second one, we looked at each other saying, we're never going to do these again. But to your point, right, the second flip that we tried to do, or the second flip that we did, we could not sell at the price that we needed to get. So much to what you just said, is we put a tenant in there for like 2.5 years, almost 3 years, just broke even on the debt service. So it wasn't costing us much, and everything had been rehabbed. So CapEx and out-of-pocket expenses were pretty minimal. And we just carried the thing for a couple of years. Sure enough, we saw a little bit of price improvement in that area too. So it probably made us an extra 10K or so. But the thing that made multifamily attractive earlier this decade, and probably for decades before, but really kind of celebritized things where the more money your property makes, the higher your NOI, the more your assets worth. Like that concept in and of itself came completely 180 in 2024 or late 23 into 24 as interest rates skyrocketed. So you had people with adjustable rate mortgages that were further exposed. I feel like all the counties, at least in Texas, woke up out of the COVID hangover and were like, holy crap, look at how much all these properties are worth. We got to go increase our property taxes. And then insurers were like, damn, if somebody's paying 175,000 a door, we should probably charge that much for the insurance too. And
Mhm.
and you get this kind of perfect storm of expenses going through the roof and then cap rates decompressing. And the same formula that was supposed to really work out in 5 years bites you straight in the ass because you're making way less money than you were because of all these factors. Then you layer in, workforce housing, economic pinch, the impacts of families that are running from ice and how they don't want to stand still very long, or they get a hint of ice in the area and they just skip town. Like all that stuff is very real. At least it is here in Dallas, and those make material impacts to your bottom line as an operator, and you got to constantly work every day to overcome that stuff. It's not for the faint of heart.
What's interesting to me, Matt, like when you just mentioned ice, I mean, every region has something they have to deal with. Like, I mean, Florida and parts of Texas have hurricanes. There's always everything, right? But mentioning ice, that's not something that hardly anybody would ever talk about, but it does affect your bottom line. If your tenants are on the run for whatever reason, you cannot possibly predict that. You cannot underwrite that. You can't do anything about that.
Right.
It's just like when COVID hit and the government says, well, tenants don't have to pay their landlords, but the landlords still have to pay their mortgages, right? How do you plan for that shit? You can't. So,
Yeah. Either that or you get in I had this conversation with my partners a couple of years ago as we came out of COVID and as we started to be on the back end of all these major fixed cost increases. You 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 start to get in your own head about all the what if scenarios. Well,
mhm.
what if COVID happened again? What are we going to do? Or what if this happens? What are we going to do? And what I found, I take version one of underwriting all our deals. And you put yourself into a situation where all of a sudden you're padding your reserves beyond the, humanely necessary, and you're just
Mhm.
pricing yourself out of deals, right? So what if COVID does happen again, right? Uh, People worked from home, they stayed there. right?
Mhm.
Uh, there were plenty of people that kept their jobs. So how do you buy assets in places where, there's less likelihood that people are going to lose their jobs and be empowered to work from home? So you kind of need to have an answer for it, and sometimes that answer doesn't necessarily live in your underwriting.
And it really can't, to the degree that you'll what if yourself out of literally making any progress.
Right.
And but I mean, look at people that owned office complexes, and after COVID, when everyone went remote, you
Yeah.
can't give away an office complex.
You're
There's
you're 100% right. Yeah.
no way they could predict that.
Absolutely not. And look, I don't think we're out of that just yet. I was
No.
looking at we've been looking at office spaces here for my W-2. I was just out looking at spaces yesterday. Some of these buildings are 50 to 60% occupied.
Hmm.
How do you live? If you're small mom and pop owner or even a medium-sized operator, 50 to 60% occupancy is like, oh my God. How do you do that?
Yeah, I imagine that they're lucky they're at break even. And if they got any kind of debt service that has call provisions, they're sweating.
Yeah, absolutely. Yeah.
Yep.
Luckily, a lot of the office owners that I know and have toured with in the last couple of months, they've owned these assets long term. So
Hmm.
I'm assuming they have very favorable debt. One company bought one in 2021 when that was distressed, and I know they got a good price on it. But yeah, that's just a tough place to be. It's just this classic. I think the last few years, Derek, have shown that real estate can be, amazing. But when it starts to go the wrong way, you got to hold on. And you got to hold on. You got to be prepared. You got to be active in your deals. There is no such thing, in my opinion, as a passive GP team. Like we're in the numbers every day. We're running our operating statements through AI to find opportunities. We're talking to our PMs. We're doing the drive-bys. And I think there's a million other things that we do that I'm not mentioning here.
Hmm.
But I think one of the things that investors got hurt with, going back to that topic just for a few seconds, is, being a GP in multifamily deals got glamorized earlier this decade. And you had plenty of folks who did deals for the ACK fee that didn't really have a whole lot of capital in it themselves or any capital. They were rolling their ACK fee into the deal, and in some cases they weren't. And when times get tough, man, what's that GP's incentive
Yeah.
to go break their ass and resurrecting your deal? If they don't have skin in the game, I'd say it's a very low likelihood that that person is going to lose sleep over their investors, their own money, right? And work their ass off in order to salvage it and get a return for their investors.
Well, and that's the sad part about people. I was preaching on this, I think, last episode. YouTube University, right? People can go out there and within a short period of time, everybody's an expert according to, themselves. And I'm going to go start a fund. I'm going to start a syndication. I'm going to do all these things. There's something to be said for real life bumps and bruises, and maybe that's getting a mentor, maybe that's partnering with somebody that's got the bumps and bruises, whatever, right? But I've seen so many flash in the pan people in my 23 years in this business, and it's fantastic. Like everybody should start, everybody should bust their ass, everybody can make it. But again, there's always a thinning of the herd. And I always think back to 2021. I saw a statistic. It was the first time in history there was more real estate agents in the country than there was houses listed on the MLS.
Wow.
And and I just thought about that for a while as I saw that statistic back then and even today, 5 years later. Um, what does that say about society, right? Like they jump in when it's easy and they jump back out or fall out or die when things get a little tough, right?
Yeah.
And I know, I think you're probably like me, you're big on mindset, like having the right mindset to to get you to overcome these challenges and stay in the fight, stay consistent. Like where's your thought process on that?
Yeah. I, I got this question on an interview a long time ago, and it was like, what do you think? What are you scared of? And my response was failure, right? Failure, not in the sense of actual failure, right? We're all going to fail, and I failed plenty of times in my career. Um, what I consider failure is getting knocked down and not having the intent, the motivation, the desire to get back up, right? That's when you've just truly folded. And, I take the fiduciary component of being a GP very, very seriously. And, my two of my other partners, we were having a conversation a couple of years ago about two assets that we had on bridge debt, and you know, we had a very complex time getting those deals refied onto agency debt. The bridge lender pulled the fast one on us and moved dates around and kind of changed the goalposts. And one of my partners was like, "Why don't we just sell this thing?" And I think at that point we'd have been lucky to get out for the loan amount.
Hmm.
And I said to my partners, I'm like, "Listen, there's two reasons why we're not doing that. Number one, we have investors' money on the line, and if there's a glimmer of hope that we can get this refi done, we have to do it, right? Second thing is, and this was selfishly, is like I said to my partner, I said, Mike, we have $500,000 in this deal between the two of us, right? Like we're both doing very well in our careers, but I'm not in a position to take a $500,000 hit right now, nor do I want to, right? So let's go back to working our asses off and figuring out what we got to do. We're going to take it one problem and one thing at a time. And we've turned those deals around, right? They're doing very well right now. So one of the things that I think benefits myself and my other partners is that we're all businessmen. And at the core of who we are, we solve problems and create opportunities for our teams. That's what we do, right? And when you get into this whole state of overwhelm where there's 94 things that are going and you just kind of want to throw the towel in, it's easy to do that, but nobody does what's easy, right? Doing the easy thing never made anyone rich. And the key is like looking at those problems, prioritizing your big rocks, attacking those big rocks and knocking the big ones into smaller ones or digestible ones, and then just go figuring stuff out. And I think that concept of critical problem solving and having a balance sheet that will help you recover from certain things uh, is the difference between success and failure in this market.
Well, in my short abbreviated version of what you just said is I don't believe you fail until you quit trying.
Yeah, same thing, right?
Yeah.
Exactly.
And I've gotten my ass kicked so many times that the general public doesn't know about. Some of it I am public about because I teach from that experience. But there's so many little ass kickings that
Yeah,
happen on a weekly basis that, I think we just get used to it, quite frankly, because nobody's going to feel sorry for us.
right.
It's kind of like saying, well, I just got off of this, week long vacation and, laying in the Caribbean and I came back and I got a paper cut. Nobody gives a shit. They only remember that you were just on vacation, right?
Yep,
It's the same thing in our business. It can be a paper cut, it could be a severed head. Nobody's going to care. All they're going to remember is, oh, you were just on vacation.
that's right. That's right.
So just get off your ass and do what you got to do.
Yeah. It's funny you bring that up, Derek. Like you just touched on a nerve, right? And I think what you just said resonates with me, right? Nobody cares. Nobody's coming to save you. At the same time, though, I appreciate people that have survived hardship, right? You look back at famous people as a whole host of stories, right? Retrospectively, they overcame tremendous they overcame tremendous challenges in order to be successful, right? But they didn't bitch about it along the way,
Right.
right? Howard Schultz, I don't know him personally, but he got, a hundred and however many banks uh, turned him down as he was looking to seek funding for Starbucks. Howard Schultz probably didn't go on Facebook at the end of every day and complain about how hard his life was and how he's got this overwhelming sense of rejection. The man was just on a mission, right?
Mhm.
And he went through those challenges very, very quietly and built something amazing. And I think as you said, like as entrepreneurs, maybe the first time you go through something, it's worth a conversation or a funny tweet or that Facebook post. But over the course of time, you just get numb to it, and then
Yeah.
you realize that like nobody wants to hear your problems, right? Flush them out, grab a therapist, talk to your husband or wife, get that stuff out there. But let folks know that despite the challenges, you got the emotional intelligence to compartmentalize and overcome. To your point, nobody cares about the scratch on your finger.
No. And that's the beauty of having a network of people that are in a similar, you know, are on a similar path than you, right? If you can have that as your network or mastermind with them or whatever, those are the people that care. Those are people like I can walk into a mastermind and say, yeah, I filed bankruptcy in 2011. And they're like, yeah, that sucks. I did it twice, right? Like,
Hmm.
here's how you get over it, right? You're around the same mindset versus you walk into a room of people that are not of the same mindset, and that could be taken totally different. And they'd be like, "Oh my God, you must be a failure. You suck, right? We don't
Mm.
support you at all." So you said something very important. You have to have somebody as an outlet, whether that's your spouse, business partner, therapist, mastermind, whatever. Because I can tell you from my experience, when you just bottle that shit up inside, um, it just eats at you and builds resentment, and at some point it does explode.
Yeah.
And and there's a fine line behind being a strong, independent entrepreneur business person and being, you know, borderline eat a bullet. You know what I mean?
Yeah.
Like I know that
Yeah.
sounds graphic, but there's a really fine line because we don't have a lot of people to go talk to, right? It's lonely at the top, some of the
Yeah.
people say, right? Um, so I don't know. Yeah, I think we have a very similar thought process on that too, Matt.
Yeah, I agree. I agree.
Well, I'm gonna hit you with the question I hit almost every guest with. What is one question I should have asked you that I did not? And it can be about anything.
Hmm. Why do I do what I do?
Why do you do what you do, Matt?
Um, there's a couple of reasons actually. You know, long time ago, I was going to NYU for pursue finance. I was also a stockbroker at the same time. This is in the late 90s when being a stockbroker was cool, or I thought it was then. And I ended up picking stockbrokerage over school. I dropped out of NYU after a couple of years. And a couple of years after that, I saw one of the kids that I went to school with, and he was working for one of the big investment banks and had a nice car and stuff. And I was being a deviant, going to clubs 5 nights a week and wearing parachute pants and stuff. It was quite the image. And I hated myself for a while, right? I'm like, I was a total failure. This kid, Marco, he graduated, he was doing really well. And I'm like, at this point, without that same piece of paper on the wall, the only thing that's going to differentiate me from him is how hard I get after it compared to how much he coasts on that piece of paper. And so that is something that's eaten and gnawed at me for a very, very long time and been supplemented by the commitment that I made to my kids when they were born. But like, I am not the smartest guy in the room. I'm openly a college dropout. But my work ethic will get me where I want to go, and knowing great people will help me get there. And so, I think that the pain of that failure combined with the commitment to give my kids the best life they could. And my dad left me when I was 15 and he just passed away recently. I never saw him again. To give my kids that kind of role model is why I do what I do.
Well, that's fantastic. And like my dad didn't leave me. Like he passed away when he was 64 years old. So like I lost my dad to where I couldn't see him again if I wanted. And that motivation too. Like two of my three kids never met their grandfather. and I just tell them about their granddad. But those are the things that I think help with the mindset of pushing us through the challenges, right?
Yeah,
It's the why behind what we do.
a
Well,
million percent.
I think it's a great note to end on.
I
Matt,
completely agree.
thank you so much for your time, your vulnerability, your knowledge. Truly appreciate it. We were talking before we started recording. I get down to the DFW area a handful of times a year, and I'd very much like to get together and shake your hand, continue this conversation, probably over
Absolutely.
a frothy beverage,
Or
and
two,
or two.
or two.
I mean, we have two hands. We might as well use them.
Might as well two-fisted. I like
Absolutely.
it.
So again, thank you so much, Matt.
This was awesome, Derek. Thanks for having me on the show. I appreciate you.
Absolutely. Everybody else, you know the drill. Go out there, share this show, help grow the Generations of Wealth family. Until the next one, live your vision and love your life. See ya.